Good
How you
morning,
doing, buddy?
Charlie.
Uh,
Where are you
I
at
use the
today? You
word
back in
I use
Connecticut?
the word gentleman, so that does not include Ben.
Oh, zinger, zinger.
Good morning, Ben.
Where are you, Charlie, right now?
I'm in Connecticut at the moment. Um,
You
got back from Europe. Europe. It's pretty
uh,
cool.
good. That's good. Did you have a good trip?
Yeah, a lot of fun. In Brussels, Amsterdam, Antwerp, that whole area.
All
Were
right,
you
all
back today,
right. Well,
Connecticut? I'm sorry, go ahead.
no,
Let's get
go ahead.
going. Get going.
All right, let's get the show going then. All right, welcome to Wall Street Beats. I am Benjamin Bry, joined with Bob Morris and Charlie Peabody. It is holiday week, and it's kind of like middle of the summer or beginning of the summer, whichever way you want to think about it. But it's a lot of things going on in markets. Let's get it going. Let's start. Charlie, what are you thinking about this morning?
A couple of things. I mean, earnings season is coming up in 2 weeks for me. We start the big earnings season. Last week, we got the results of the annual capital bank capital stress tests. It was somewhat uneventful in the sense that prior to announcing the results, the Fed had said they're going to freeze all capital ratios at the 2025 levels. So while we had the stress test and it was going to, you can read from that stress test what's going to happen to capital ratios next year, it's not going to have an impact this year. Um, but what I would point out in that, because analysts like myself can figure out what the change in capital requirements would have been if the Fed hadn't frozen the stress capital buffers. And the two, I guess, surprise results were at JP Morgan and Goldman Sachs, which would have seen their stress capital buffers rise by about 30 to 40 basis points. Of those two, I would say Goldman has the least capital flexibility. JP Morgan still has about 40 to 60 billion of excess capital. So I don't think it's anyone's going to trade JP Morgan as if they have tight capital levels, but Goldman Sachs does. I mean, they probably are going to be affected by this in terms of how much they can buy back going forward. On the other side of the spectrum, those that saw the greatest capital relief, and this was anticipated, were banks like Citizens Financial (CFG), Citigroup, um, M&T Bank, to name some of the ones that I've been talking about in the past. So, you know, basically, you're seeing capital relief going forward, but it's not going to be seen until the second half of 27. So that's that on the capital front. Um, I can talk about names that I like and have been buying, but I don't know if Bob wants to get in here or not. Or
We could jump over. Bob, what are you thinking about this morning?
I'm just watching what's going on with Iran. I mean, obviously that's top of headline, and we had a little tit for tat over the weekend with uh, the Iranian Revolutionary Guard apparently attacking some commercial vessels in the Strait of Hormuz, and the U.S. retaliating. And at one point, Trump saying he was going to annihilate Iran, but then backing off and saying, no, we're talking again. And we've got a hotline open between the U.S. and the IRGC. And Vance is back over there, I think, Switzerland this week to continue discussions. What's interesting is the near term discussions were supposed to focus on Iran's nuclear program, but apparently they've shifted over to focusing on keeping the Strait of Hormuz open. And so apparently commercial ships are flowing freely through there this morning, and oil prices hugging around $70 a barrel here, which we talked last week about the fact that it seemed that all the positives were in the oil price and there was only room for negatives to come about. So over the weekend, this was initially a negative, which popped oil about a buck or so, but then it sort of backed off when everybody said, well, no, they're talking again, and they've agreed to stand still, and they're talking, and commercial vessels are flowing through the Strait of Hormuz. So, again, I think it's 95% positive news reflected in the oil price, which means that anything negative, anything that goes wrong could lift the oil price. So we're watching that. But again, we talked last week about the fact that I think at this stage, Trump is under pressure to make a deal to get things smoothed out and not re escalate any military action with Iran. I think there's a lot of pressure, especially with the midterms upcoming and what we've seen in the recent primaries um, in New York and elsewhere. There's a lot of pressure to kind of tamp things down and focus on getting things in line for the midterms here coming up later this fall. So, we'll see how this plays out. The problem is, I think there's still three factions in Iran. It's not clear who they're negotiating with. We don't know the details of the deal. If they're negotiating with the elected officials, the mullahs, or the Iranian Revolutionary Guard. And I think the IRGC is a bit of a rogue entity in that they may not necessarily be falling in line, and they're the ones that initiated the tax over the weekend on the commercial vessels. So, as far as the oil stocks, we're just holding steady here. We talked last week that they probably reflect around $65, $70 oil, but the names I like, I would stick with here. In the meantime, we're watching natural gas prices. Interestingly, nat gas is holding in around 320 despite some very hot weather across the country. So, names like EQT and Expand Energy are holding steady here. But again, those are the names. If anything, I'd look any pullback to add to or, be more constructive on if they were to pull back, whether it's because of natural gas prices or in sympathy with any further weakness in oil or the energy sector in general. So, nothing, you know, transactional this morning, really just holding and watching and seeing how this plays out in Iran and what if we do reach a deal and sort of what that is.
What? Well, here's a question. What when we say deal, like what the hell does that mean? I mean, like we're on like month 4, and all they always talk about is deal. And God, we're on year 10 or whatever of Trump, and you guys remember the tariffs back in his first term? Like, oh, we got a deal, we got a great deal. And then last year there's a deal. Like the guy squeezes the deal algorithm on the market more than anybody in history. Like how does the market actually know it's a deal? And like what
It's
like this weekend we had a tax. Like what does that mean? I don't.
it, it's all about controlling the narrative, right? That's all it
Yeah,
is.
and it's a good question because we've not seen any details of the MOU, and we know that Iran's playing this stall game, and they're going to try to wiggle out some way to cheat or whatever. They've kind of started from this whole negotiation process with the idea that they have the inalienable right to have nuclear power and enrichment and all that. And so, at the end of the day, is it just going to be, oh, we're going to have inspectors again, and we're really mean at this time, and they're really going to let the inspectors inspect everything, and or are they actually going to extract the enriched uranium that Iran has and take it out of the country? I don't know. It's very sketchy. I think the hope in optimum case that Trump was looking at going into this was regime change, and clearly that didn't happen. And you've got a situation where basically the ruling party or whoever over there what killed 40, 50,000 people in the streets, and they're going to get away with it. We're negotiating with them to say, okay, yeah, well, we'll sort of release funds and open up the Strait of Hormuz and do all these things to play nice as long as you agree to either get rid of your enriched uranium or let us inspect and promise that we can watch and make sure you're not enriching uranium or trying to develop a nuclear bomb. So, in some senses, Iran held on, and they know that, and they're still playing this sort of, cat and mouse game and stall game and waiting to see what happens here. So, what is the deal? It's a good question. We don't know, but at the end of the day, is it going to be hard, verifiable, defendable deal? I don't know. I remain skeptical because whatever inspection process or monitoring process they put in place, we know Iran's going to try and circumvent it or cheat or do whatever they can to get away with what they've been doing for the last 15 years. So we don't know the details of the deal yet, and that's sort of what was part of the apparently the blow up between Trump and Republicans behind doors last week, where there was a shouting match. But is they don't really disclose what the details are of the MOU.
Ben, I think, as you guys have implied, it's all about controlling the narrative. There's no deal. But, I wonder if that's also playing out on the Fed side with Warsh. And this is where my question comes to you, Ben. I mean, if you look at December SOFR 27 futures, They priced on Friday at the close above where they closed after Warsh's rhetoric, hawkish rhetoric at the FOMC meeting. So in a sense, the market was fading Warsh. Now, to be fair, the December 26th SOFR futures priced below the June 17th price. So I'm wondering, is the market, Warsh is trying to control the narrative. He's probably convinced Trump that you know, sounding hawkish is important right now, but will he actually be hawkish? I don't know if you have any thoughts about Warsh's intentions and his rhetoric versus his actions.
Yeah, I mean, we talked about this last night on the podcast with Rupert, and like, they all come out kind of hawkish. Most of these central bank, when they first start in, the new governors, they want to establish credibility, right? Bernanke came in, and his name was known as Helicopter Ben, and he raised 16 times in a row, and for all intents and purposes, kind of blew up the market. And you had Jay Powell came in, and he was real hawkish right off the shoot. And so I think he's coming in and trying to establish some credibility. But like, Charlie, as you know, we have $2 trillion of private credit. We have the AI boom is like funded in a big way by the private credit. These guys fund off of SOFR, right? So, in a market where we're seeing redemptions hit that 5% gate every quarter, and it's rising, so the percentage that's being requested. So if you think about it from a bank funding perspective, it's like, oh, they're having a run on the bank, but they have this liability structure in place where they have a gate that prevents a true run on the bank, if you will. And so I don't think that he's in a position to really jack up SOFR because of the credit side, right? And so I think that when you look around, he doesn't want to be a pushover or look like he's just Trump's, little peon. And so he has to come and have some strong language. And I do think some of the things he was saying make sense to me, of like some of the overall of the Fed, like the data collection and moving forward guidance. But like, yeah, I personally, as you know, don't see that happening. And I think Z7's a buy, because I think rates will be lower. I mean, let's just play out the idea like the AI capex boom rolls over, right? And if you look at the hyperscalers, the top five guys, well, their stocks are down 16, 17% since the end of May. Okay. So the market has woke up to the idea that, debt funding is not necessarily, because I created a website and I have a free cash flow negative countdown on there. And we're 78 days until negative free cash flow for the hyperscalers. Okay. And so I think it's like, oh, well, Micron and the semiconductor companies are getting the benefit. But like, there's a point here where these stocks, the hyperscaler stocks, are going to be discounted, and if they keep getting discounted, eventually they're going to care about their stock. And so, if you have a situation where these guys can turn it down, well, then that's been the biggest driver. And you have this private credit plus that. Like, I don't see how raising rates does anything except for accelerates the process. Now, maybe that's what they want to do. The Fed has always been, they like to do that death shot at the end. They like to like tighten when they shouldn't, and that's usually how cycles end. But my opinion is that he's not in the business of raising rates. Like, I don't see what the purpose of that is. And Charlie, if you look around the market, like there's not a lot of stuff that's at the highs the way that it was. We have the memory stocks, but like, okay, memory's a bad business. It's a commodity business. Like, this market, like a lot of the guys that were hot are way off their highs. Like Microsoft's 33% off, Oracle's 32% off. Palantir, which was a big hot one, is like 40% off. So, I think we're more along the process than people think. But when you look at the S&P near the all-time high, you just don't get that sense. And so uh, it, when I look at like the data center stocks, CoreWeave and that stuff, they're getting drilled. Look at the credit market. I mean, SpaceX comes out and does a $25 billion bond deal last week. It immediately cheapens 33 basis points in the cash market and about 25 in the CDS that just started trading last week. CoreWeave, their CDS up 100 since the beginning of the month. So credit market's paying attention to this, and I just don't see how, if the credit market's starting to price more in that direction, how that's then going to result in them being like, we got to raise rates. So maybe I'm biased because I'm kind of a bond bull, but like that's kind of my take on
Hmm.
it. But having said that, Charlie, what are we looking for? Just a little mini preview on the banks. It's the holiday week. We get a little time. Like, what are we looking for as we come closer to the
Yeah,
banks kicking off earnings?
the big banks start reporting July 14th. JP Morgan sort of starts the whole process and sets the tone for everybody. And they're going to, all the banks are going to report really strong second quarter earnings. It's going to be double digit, EPS growth. Um, the thing that I focus on. So anyway, the results are going to be very positive. But everything changed on the 17th of June when Warsh came out with his hawkish rhetoric on rates, and so the yield curve is flattened dramatically. I think we're around 30 basis points between twos and tens. We had been as wide as 70 basis points back in February. So I'm going to be more interested in the commentary about the second half. Um, and there are two things that you're going to want to listen to. What impact is the flattening of the yield curve have on net interest income forecast for the second half of the year? And then secondly, as you mentioned, Ben, the debt spread widening trade is going to have an impact on capital markets. And, there is tremendous optimism about the pipeline of capital markets activities, priced into these stocks. But again, everything has changed in the last week or two on the capital markets front, as we've seen, disappointment in IPOs in terms of their secondary price action and debt, issuances. There's only so much of this negative secondary price action that portfolio managers are going to accept before they say no mas with respect to future issuances. So that secondary price action, which has not been good, is going to have a big impact on the confidence of portfolio managers continue to fuel this pipeline of expected activity. I think the potential big losers there are going to be private equity and private credit. I continue to think they are the epicenter of the next credit crisis, and they are the equivalent of the trust companies back in 1907, the panic of 1907. And we wrote about this weekend. I'm getting off on tangents here, so stop me if I get too far afield. But Apollo has come out with a new product called AMAPS, AMAPS, and it basically is a new product that is going to replace their CLOs, because the regulators, led by Scott Besson, and the insurance regulators have been criticizing the insurance company for the risks they're taking on their balance sheets. And so, something like Athene, which is owned by Apollo, had, I think it was about 33% of their balance sheet in CLOs. And so they're trying to run those down, and they're replacing it with this thing called AMAPS. Well, AMAPS literally removes the investor 3 layers from what they're actually eventually investing in. I'm not going to go into the details of the structure, but it basically layers investments upon investments. So you really don't know what you're investing in at the end of the day if you're the end investor. And this opaqueness and obscurity of what they're trying to do is what's gotten them into trouble in terms of their multiple devaluations or derating of their stocks. And so I think sometimes Wall Street can be too clever for their own good, as they were back in 2007, 2008. And I think what we're going to hear, in going back to your question in the second quarter earnings, good reports, but concerns about the second half. And I think the concerns are going to continue to mount for these private equity, private credit groups, as reflected in the redemptions that keep coming at them. Sorry, a little went long way.
Yeah, yep, yep, yep.
The
All right.
bottom line of all of that is, I've written about this, but PPNR, which is pre-tax, pre-provision net revenues, um, the change in rate of growth has the best correlation with bank stock prices. And PPNR this quarter, second quarter, is going to rise 16, 17% year over year. That will be its peak rate of growth year over year. And by the time we enter 27, it's going to slow to a mid single digit rate of growth. And so if you think about PPNR, it's basically gross revenues minus operating expenses. It doesn't have any credit costs in there. And so as the rate of growth slows, you have less of a cushion to absorb rising credit costs. And I do believe the corporate credit cycle is going to get more strained as we move into 27. So essentially, if you think about it, you've got less cushion to absorb rising credit costs, which means your pre-tax income is going to grind to no growth. And that's why I think bank stocks have peaked in our sells here.
Yeah, I mean, XLF is near the highs right now, isn't it?
It is, and I did write about that. I mean, it's been led by the KRE, it's been
Yep.
led by the BKX, and credit card stocks. Even insurance stocks have had a nice run in the last couple of weeks. But what hasn't done well have been these private equity, private credit names. Some of the exchange traded names like ICE, have not done well. CME have not done well. So you're seeing this sector rotation within financials as you are within the broader market. And there are certain groups that have done well, and there are certain groups that have continued to lag. I think banks are a sell here, even though they're trading close to their highs.
Yeah, yeah. I'm just looking at Apollo right now. It's at a rough, 5 or 6 trading sessions in a row. 141. Now it's at 115. Um, yeah, I just think that that's right. I mean, when we think about these banks, and you think about the private credit, like that flow through should be there, but it seems to not be there. I mean, what is it that would take it from, hey, these guys are struggling, and this means something for the banks? Like, how does that mechanism work?
Well, the banks have the funding rails upon which private equity rides. In other words, the banks are a source of liquidity for private equity, private credit. And so if we do get significant, blowups in private equity, private credit, it's going to reverberate back to the banking industry. But we're probably 2 quarters away from that, becoming more visible. So it's more of a counterparty risk, um, and a revenue risk in the sense that these financing rails are generating tremendous net interest income for the big banks. And if the banks, get nervous about their counterparty risk, they're going to pull those funding rails, and so you're going to get less growth in net interest income.
Right, 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 right. All right, Bob, you got anything else that you're of interest this week? Anything you're
Charlie,
looking
on
at?
didn't one of these funds, I don't know if it's Paulo or somebody else, um, restricted redemptions? Is that going to be a signal at some point that sort of spins things, signals things are going awry when if there are further gates on redemptions as people begin to panic or
Yeah,
become
I mean,
concerned?
so they all had redemptions in the first quarter. Some limited it to the five cap, some up
Hmm.
100% of the requests. This quarter, it looks like everybody's limiting it to the 5%. And there have been a number of entities. And if you go back and look at what happened with B REIT when the commercial real estate, problems hit the industry, those redemptions went on for over a year. And so anyone who thinks these redemption requests are going to end here in the second quarter, I think is being very short-sighted, because there is a map already with what happened with BREIT. This is something we've also written about in some of our private equity pieces. So we think the redemptions are going to continue. And the redemption requests this quarter, some have been as high as 17%. So it's not insignificant.
Yeah.
So.
No, on energy, nothing else, Ben. Just kind of
No,
All
watching.
right.
Bob, for the
Go ahead.
first time, I would say, and I'm just looking obviously for your approval, but I stopped buying energy in the run up into, I don't know if it was March or April where they peaked, but I'm back buying energy again. Do you think they bottomed, or is that hard to tell?
I mean, if oil's bottom, then I think the stocks have bottomed here, and I think oil is close to bottom. I can't see, like I said, we priced in. I think everything that's almost positive here. Is oil going to go back to 65? I don't think so. And I think part of the reason it's overshot down to 70 here is just sort of the funds flow and a lot of these hedge funds just being short oil and waiting for sort of the dust to settle for it to bottom out. So yeah, I'm not selling anything. Um, and like I said, I think if anything, I might be sniffing around at some of the gas names, but I think around here, $70 oil. Are we going to go to 65? I don't think we're going that low, but I do think that they've likely bottomed here.
Yeah, on your hedge fund comment, that's what I've been hearing as well. The hedge funds are significantly short oil, and they've been pressing those shorts into quarter end for performance
Yeah,
reasons. So I think you do get a bounce coming out of the quarter end.
yeah, we'll see. But like I said, I think maybe we end up having a deal. This quote deal, but I don't see a lot further downside to oil from here.
And
All
I
right.
think if we do get a deal, it's a buy.
All right. Well, I think that we're rounding up against the time now. Let's call it for the day. It's a good start to the week. Should be an interesting rest of the summer. I am Benjamin Bry. That is Bob Morris and my man Charlie Peabody. We were Wall Street Beats. We'll be back tomorrow. See you guys later.
Thanks, Ben. Thanks,
Thanks,
All
Bob.
right,
guys.
guys.